Hello everyone, it's me, the Boss Hog, and today we've got lots to go through. We've got all-time highs for my portfolio, which feels really good. We've got some new images for my YouTube channel, as well as a new dashboard that I'm really excited about. So very different style of video today. We're also going to look into some retail news as well, where I'm increasingly optimistic on the sector. Let's do it. Okay, so welcome to my Google Tracker. This is a new dashboard that I have, but I'm going to just spend a couple of minutes just walking through this. I haven't shared it a ton. Effectively, though, what I do is I take information from Trading 212, which is the brokerage that I use, and put together multiple accounts in Trading 212 into this document. It helps me manage it and it gives me a clear overview. Broadly speaking, the way that I do that is once a week I'll download transactions from Trading 212, which is this tab here. And then from that, I'll do a couple of things. So first of all, here I'll do a company lookup, and this basically helps me link Trading 212 names to Google database names, and that's done with a ticker primarily, right? A unique one, which is in Google Docs, you basically have the exchange reference, then a colon, and then the stock ticker. So that's basically my way of linking Trading 212 with Google. We then basically here can produce that for the ticker, which then allows me to take here the information from Trading 212 and link it into a Google portfolio. So here I've just filtered for my current positions, but what this allows me to do is basically pull back a bunch of information on each one of these companies and start recording that information in quite a lot of detail into this table. So we don't necessarily have to go through this now, but effectively it enables me to do a lot of the reporting that we're going to look at in just a moment. So that's how we bring that together. Then on this tab here, I have day end figures. So as you can see here from the last 5 days, I've had a pretty fantastic last 5 days, up 8,000 in a week. My several UK holdings have done very well. FX movement has been favorable. And then I've had sort of 14% improvements from Amcor, from Huntsman. I've had good movements from Games Workshop as well. All of them are like top 5 positions, where I've had like 13-14%. So most of my portfolio is up this week, and some of my larger positions are up very significantly. None of my larger positions are down at all. So I think my worst one is Genius, which is up just a percent. So very strong period basically. And what I do is that at the close of each day, I take a snapshot and then move on to the next day. Basically, is how that works. And these two figures here are just representing my US win or loss for the day, and then my UK win or loss for the day. So previously what I would have had to have done is basically go in here, put it into Excel, etc., etc. But that was quite time consuming. But this is how it works. And in this reporting tab here, it's mostly been replaced with the dashboard, but this is just bringing it all together. The most useful part here, and I think this might be interesting to one of my subscribers who was asking me how I compare myself with the other exchanges, so the other indexes, so the S&P 500 and the FTSE 350. So what I basically do is each month I take my performance within that month, right? And these are based on real values. And then I basically take that information and put it down here. So I started recording this because I started basically very late November and then got really going in December. I actually just measure myself from December. So this 2.81 here is 2.81 there. The 0.23 here is 0.23 there. And then the way that this time-weighted performance works is that each month we basically take £100 from how it would have started in December 2020, and then compare it against how the other markets performed, and that basically gives us our information. So this table here still needs to stay, but otherwise a lot of this stuff I'm going to clean up, because actually we can just talk about the dashboard, which is really bringing it together. So I'm going to move over to here now, and this just enables me again to manage my portfolio at a very simple and easy level. So I'll just walk through this top table first of all, because it's very helpful. So this here is one of the few manual parts on this dashboard. Literally before this recording, I just went into Trading 212 and took the amount that Trading 212 says I have in each account currently. Then here, this is our net deposit. This is net deposit rather than just deposit, because especially in the early days of my investing, I was moving money around between accounts, but it got really messy. And also I didn't realize, but Trading 212 doesn't enable you to take money out of an ISA and then put it back in. So that's quite important from a tax perspective. So originally I was basically funneling it all into like one account and then dispersing it. and then realized I had to set them up. So that's what I mean here by net deposit. Basically, there are withdrawals and there were deposits, but this is my net position for those. And then, and by the way, the net deposit here, this is taken from the transactional records as well, right? So the deposits and the withdrawals, and then this gives me my net figure. Then we've got basically everything that we've walked through here, the Google Docs. So this is what I believe, or what Google tells me I have valued. Now, first of all, you'll see that this is about £440 different. Quite often, and if you actually look at the breakdown here, you'll realize that my wife's ISA is the biggest difference, and she has the majority of US holdings just by fluke. That's just the way it worked out. And I think basically it's a result of sort of primarily FX differences that sort of even out over time. So yeah, so I'm not concerned by this delta, but I think it's important to highlight it and explain the reasons for it. Obviously, if it was a bit more material, then I'd need to investigate and etc. And then what we've got over here basically is, again, our realized P&L, our unrealized P&L, our dividends, and our P&L. So again, this is all just taken from transactional records from previous, aggregated up into company level for my portfolio tab, and then aggregated up here for each account. So that's how this table works. Now the P&L here, just to be super clear, is based on my Google documents, right? So if I take these figures, I'm basically going to get 5448, which matches with this figure, right? So realized, unrealized, and dividends. So that gives me my profit and loss. But obviously here, another way to look at this would basically be to look at my Trading 212 account and basically do that minus deposits, right? And this should be about £400 out, and you can see it is, right? Because that's the same difference between Trading 212 and Google. So for me, moving forward, the way I'm going to present this in terms of, my introductory thumbnail is I will be using Trading 212's figures to talk about the size of my portfolio, because that's actual, but then I'll be using the profit and loss figure here, which I think makes sense because I have all the data that feeds up into this, so it's just easy for me to talk about. So again, as long as the delta isn't particularly large relating to the size of the portfolio, I think that's absolutely fine. And hell, it's my video, so that's the way I'm going to do it anyway. Moving on then, so next up we've got the portfolio value over time. So this is very simplistic. It's just basically how much money is in the combination of these portfolios. Big jump here at the beginning. The reason for this is I started investing when my daughter was 10 months old, and my wife and I had basically built up a large sum of money just in case, anything happened with one of our jobs or etc., etc. And when it was determined that she was going back to work, we realized that we basically had about 50 grand in cash. And so we were able to put it in quite quickly over sort of a 5-week period. We went from 0 to 40,000, right? And likewise, if I go back to the reporting tab, that's really what happens here at the beginning, right? I buy in here, and then very quickly I go up to sort of 40,000 by the end of December. And then it kind of grows more gradually over time. So that's that. We're currently all-time highs, which feels really good. So 120,000 according to this. Although of course Trading 212 there will give me 119.8. But anyway, yeah, this table here is showing my 120, which is again an all-time high. So that feels super from that perspective. It's been a difficult journey here. This was when I was my profit was at its best, right? You can read down here as well. Maybe that's a good segue. So this, I was massively outperforming. And had an amazing profit. I think my highest was like 17,000, 16,000. Yeah, 17,000 here. And then this here is when Ukraine was invaded. And again, I had very heavy exposure to Russian miners. You can see here as well that as a result of that, my UK listed holdings in the light blue really suffered. But they've been making a bit of a comeback recently, primarily driven by Games Workshop and then a few others as well, like insurance companies and Hollywood Bowl, among others. So you've been seeing that climb, but technically my UK positions are still negative overall. So this is my profit. So you can see that even though our portfolio is at all-time high, our profit is yet nowhere near all-time high, basically. So there's still a bit of work to do with that. Then this graph here is probably the most important graph because ultimately it determines my success as an individual compared to the market. So my more important comparison is against the S&P, and that's really because I've built my portfolio to be more tech focused and more long-term focused. So to me, it makes more sense to compare against the S&P. I think from memory, the FTSE 100 only has 2 tech companies, which is Ocado and Sage Group, right? At a whole 100, we have 2 tech companies in our FTSE 100. A lot of it is sort of commodities, insurance, oil majors, that kind of stuff is strong in the FTSE 100, and that's part of the reason, by the way, why the FTSE 100 has done so well. Right, in the bull market, it was actually underperforming, dividend companies, etc., etc. But since then, it's actually held up remarkably well. It was one of the best performing last year, and actually it continues to outperform me. I am starting to chase it down, but every time I get close, it feels very difficult at the moment to catch up with the FTSE 350. But the market cap weighting is clearly driven by the FTSE 100. But even within my portfolio, I don't have a ton of FTSE 100 companies outside of insurers. Actually, a lot of my UK holdings are FTSE 250 and AIM. I've gone for sort of smaller growth companies rather than the established companies on the whole, with the exception of my insurers is the big standout for me mentally. So here I'm very pleased with my outperformance, especially again, this is the invasion here, get absolutely crushed. And for me, I was really pleased with how I responded following that. I kept calm, I revisited my holdings, I did make some changes. And since then, I've been able to kind of claw back and recently actually been able to build up over the S&P, which has kind of gone off to a sluggish start. And then I've had some good news on some of my larger holdings, which has helped me extend that a little bit. But I'm really pleased with how I responded because that did feel really rough, that part. And I think it's kind of... my kind of advice would be that if you find yourself in a situation where you've made a mistake, or maybe just a black swan event happens, right? You buy into a company and then suddenly it turns out it's got fraud or something inside it, right? It's just a case of, okay, right, we diversify for a reason. Let's revisit this. What lessons can we learn, etc. So we've gradually been recovering from that situation, and we will continue to build from there. Next up here, we've got a dynamic table that links with, again, the Google Finance database that this is based on. But previously, I felt like my presentation of similar data was turning into an eye chart as I tried to link everything together. So I've really stripped that back quite a lot and kind of borrowed this from ISA Investor, who apparently borrowed it from Osborne. But effectively, it's a very similar thing. So here we've just got the ticker as we discussed before and the company. And then the number of shares that I have basically, and this is again taken from the transactional log. So any sells, any buys, it all kind of nets off here. The current share price as Google Documents sees it. Then the value as it stands as a combination of that equation basically. And then over here, it's just week on week change, month on month change, quarterly change, and year on year change. So here it's just a lot easier now for me to talk about. The other good thing about doing it this way is beforehand it was like too personal to me because the week on week movement was based both on the share price movement as well as the FX movement. So it actually wasn't particularly clear how the data that I was presenting matched back unless you happen to have similar exposure and you were buying in sterling and everything else. Whereas here, if you were to check Google or Trading 212, you should see very similar numbers. So I did have a little bit of testing around on this. But you can see, the week on week here, Amcor's been very strong. Quarterly, especially since the earnings has been particularly strong. And this should just make it easy for me to sort of see how the companies have been performing. I just realised actually my value here should be moved across one, so we'll fix that shortly. And then likewise, I'm going to give myself like a note section over to here just to talk about sort of buy, sells, etc. that I've done. Again, instead of sort of having multiple tables to talk about, we can just flag this. So I haven't quite automated this yet, although it's pretty close. So yeah, I'm hoping to have that in place in a week or two. But even if I can't get it automated, this takes me 5 minutes. And I'm just, for Huntsman here, I received 2178. And then for Huntington, I received 2178. And then for Huntsman, I received 3417. For me, I was more than happy to just reinvest back into these companies. No issues with that whatsoever. And similarly, actually, for my digital security ETF, very small dividend, but just put it back into there as well. So I'm now green on Huntsman, very modestly. But as of today, I'm green on Huntsman, so that feels really good. I've actually been in Huntsman a couple of times, so I'm very green overall. I've made about £4,000 profit in Huntsman. And in fact, just to go and find out what we could do is go to our reporting, go to our portfolio tab, find Huntsman, which is here. And then just scroll across, and this is then going to give me my overall profit figure, which you can see is sort of 4.3k overall. So this is kind of very useful for me to sort of look at previous. So this is sort of a combination of both live positions, unrealized positions and realized positions as well. So that's a good way of kind of looking back historically about where the money has come from. So that's how this table will be working. They're not applicable here, just means that occasionally Google has funny 5 moments and you just need to refresh the document, but I won't bother with that. With the exception of Everas, actually, and because of the sanctions and the war situation is not currently able to be traded, my broker has frozen it at like 81p, so that's the figure that I'm using to get to that figure. But again, you won't be able to search for performance for the share price because of that situation. And again, the error there. Moving on then, just a couple of final graphs. We won't necessarily touch on these every week, but I think it's good to give you an overview of what my portfolio currently looks like. So again, very technology heavy. Consumer discretionary, we're going to talk about that a little bit more in a few minutes, but I remain quite bullish actually on consumer discretionary. So yeah, really happy to have that in second place. Then utilities, financials, etc. You'll notice here, by the way, I don't have any healthcare. That's part of the reason why I got a new ETF in healthcare. And I am also considering as well, like right now I've got 11% in an ETF. I expect that figure to grow over time. But I'm also thinking here of having like a second pie chart where I more or less break down the ETF into sort of its constituent parts, or at least, maybe we take the top 3 areas or something, just to see how it falls. Because what I would expect to happen is things like technology would actually increase because I've got a lot of tech ETFs. And other positions like healthcare would then suddenly open up. So I'm going to have a little bit of play with that in the future and then kind of put them side by side and see how they look. Then in terms of dividends, I just think this is worth talking about because it's really cool. I recently got past the £5,000 dividend level. You can see here I don't necessarily have the traditional journey of dividend growth, etc. So I think this chart here looks really strange initially. Part of it kind of can be explained by looking at both of these top graphs here. And really what you saw from me in sort of November 21 is that I moved a lot of my US holdings into UK holdings. So at the time I was kind of 60% into the US, and US companies pay every quarter. And that was very deliberate, but it was mainly because I was doing it because I expected favorable FX movement over time. I actually wish I'd gone slightly heavier into US companies, but because it definitely has been a benefit to me to take advantage of that a little bit. But the way that UK companies work is that they only pay twice a year. And that's really what you kind of saw here, where, March especially was down, April was down, but then all of a sudden the May caught up where I had sort of some quarterly income, but a lot of very large UK payers, sort of Phoenix, Legal and General, kind of other big dividend payers as well. And then a very similar thing happened in September as well. So today I'm at almost 50-50 between it. In fact, let's just find out how I'm split. Oh, I'm erroring. That's really frustrating. But yeah, so I'm about 50-50. And that's explaining it right. And almost on this graph, you can kind of draw a dotted line between these two. And do it that way. And again, this here as well, this is basically full year dividend in the UK, and then this is interim dividend. So I expect to sort of see those double spikes moving forward. Likewise as well here, I think the best one to look at the bottom is dividend by year. So I'm really pleased with this kind of growth. I think this is the more important one to look at, is the year on year. And you can kind of see it here just because there aren't a ton of graphs. But you can almost put this up, put this down, etc. And then you can you'd have a read across here and then a read across about here. So it's not the best to look at because I don't have a kind of traditional dividend journey. And my own experience with dividends, I started with like a 4% yield in my portfolio. Then I went down to sort of 1.5, and now I've gradually been drifting up my dividends. And certainly I've realized during the last year, which was quite difficult, that having dividends and basically having companies give you money to average down is tremendously reaffirming and kind of gives you that good news to hold on to when your portfolio is turning to very deep shades of red. So that to me has actually been really useful, and I would consider myself firstly as a bit of a value investor. I've got a bit of a soft spot for sort of value turnaround opportunities, etc. And I'd like to think I'm good at that. I've definitely made some mistakes, but I've also exited quite well in certain shares and have picked up what I consider some good bargains in kind of underloved companies. But then I do just really like dividends alongside that. So, if I can find a dividend payer that I think has been beaten up, like the likes of Hollywood Bowl or Games Workshop, what else would appeal to me currently? Huntsman, I think, is a good shout out for that as well. I couldn't believe when I was picking it up in the past at $24. That just felt incredible. And there's a few others as well that I would group into that. It feels just really good to be picking up companies that have both potentially good capital upside as well as good dividend. Maybe I'll put medical properties in there as well, just to be a little bit controversial, because I know that divides opinion. So yeah, this is my dashboard for now. I will probably look to add to this. Look, you can see that everything has errored out. Let's see if I refresh or if it wants to come back to me. There we go, and we're back again. So it's been quite frustrating with Google over the festive period. I suspect that they're doing some work in the background, but normally a refresh fixes it immediately, which is what we're seeing now. So for me, it works. It just means I don't have to continuously go into Trading 212, open up accounts, take information, and for me, I have the reconciliation. So this is how I'm going to be doing it moving forward, and we'll potentially look to call out specific points that I want to talk about. And from next week, we're going to start really doing some deep dives. So we're going to have a dashboard walkthrough. Then we're going to look at my, my top 10 list in terms of any news. And then we're going to start really delving into companies and kind of offering value as I see it. So hopefully that sounds of interest. And, I'm looking forward to doing that as well, actually. So that's it for now. I'd welcome some feedback, but without further ado, let's have a look at the news from our selected companies that we'd like to talk about. All right, so no changes to this bit. I did think about incorporating this into the dashboard, but I wanted to keep the dashboard really clean and dynamic, whereas this requires a little bit of reading, and to be honest with you, I quite like doing that anyway and talking to you guys about it. Again, I still think I can improve the aesthetics for this bit, so I'll give that a bit more thought. But for now, I'm just going to walk through its standard stuff, and likewise as well, I've organized it in what I think is order of importance. So I'm going to start with Games Workshop. They continue to solidify their gains following the Amazon tie-up. It has pushed slightly higher this week. We are expecting a relatively positive trading update on the 10th of January. For me, I'm expecting a revenue increase between 5 and 10%. The general consensus is around the 9% region. I think for me, it'll be very interesting because the revenue for me is the more important aspect here. I've spoken beforehand about the fact that I expect earnings to be basically flat. The reporting period from the licenses was a bit down last year compared to the year before, and that's going to have an impact on the margins, as well as the fact, as I've touched on, they had a bunch of scaling issues around freight, logistics, and raw input costs, basically. So for me, I'm actually more interested in revenue. I'd like to see high single digits here, and anything over 10 would be a real surprise, but within that region would be solid, would be my summary here. It's got very tough comparables as well, because it's still against the lockdown period where it saw very rapid growth. So likewise here, strong single digit growth to me would be good news. I'm also expecting a dividend of about £1.20. Now, Games Workshop has moved itself to a quarterly dividend payer, and so this is like a £90 share now at the moment, and I'm expecting it to be yielding about 5%. So, a really strong yielder. I think a lot of people don't realize just how much money this company is now throwing off. I would actually point out here that I'm on the much lower end of expectations, so we'll see how this looks. I think the average is about 150, but yeah, this is what I'm expecting. Obviously, any upside, I'll be very pleased. In terms of the updates beyond that, I'm just expecting more or less a holding comms in terms of the Amazon tie-up. I'd be surprised if there's any news at this moment in time. We will see. Also worth sharing is that the World Championships for the various Warhammer games, as technically 4 of them that they're looking at having a World Championship on. The big one, of course, is Warhammer 40k, but also Age of Sigmar is also very big, and then a couple of their smaller franchises as well. So it's basically going to be the largest event that Games Workshop has ever hosted in Arizona in November 2023, so the community is excited about that, it seems. And lastly, I also think this was worth sharing because I guess part of the concern with Games Workshop is that they've kind of milked their customers for all their worth, maybe haven't engaged with them, that they produce overpriced tat. But actually, I'm not really sure that is the case. So what happens is every now and then Games Workshop do supply drops, but they're basically in real life loot boxes. You pay sort of between 60 and 90 pounds, and you get random stock. You don't know what's going to be in your supply drop, and it's a good way for Games Workshop to basically get rid of anything that's been overproduced, anything that's been discontinued, etc., and a good way of basically shifting stock. So each of its regions will get different supply drops and everything else, and basically it's sold out in 3 days. They haven't done a supply drop for a couple of years, and this was well received. Also, as well, it tends to create a lot of content where people will open up the boxes and see what's in there, etc. So for me, it was just a good sign that Games Workshop is able to manage its stock in this way, and that it's still desirable to have this stuff. There was also a lot of demand for non-chaos, non-Space Marine factions. A lot of people will play with other armies, and they wanted other supply drops as well. So it'll be interesting to see whether Games Workshop goes down that road. I'm not aware that they call out how much revenue they make from these kind of events. If anyone is, please let me know, but I definitely haven't been able to find the information. But it's ultimately a decision that they choose to make periodically from a commercial perspective. Genius Sports here. I do think actually this is quite an important update. I'll almost put this top of the list, but effectively it won its second legal settlement in as many months. This time against a company called Soft Construct. And basically this is like a gaming/gambling company that's using the data that Genius has exclusive rights to, right? Basically buys the data and then sells it on. It has like 3 different revenue streams, and data is one of the big ones. And it's important basically that not only did they win, as I would count it, in terms of the fact that Soft Construct have agreed to enter into a long-term commercial relationship, but as part of that license, basically Soft Construct accept that Genius owns the data that sits behind it, and ultimately it's their information to sell and Soft Construct's information to buy. So for me, this is again a key part of the business, and to me it's actually the more stable revenue stream, right? The other parts around sort of betting value add is slightly different to the big data stuff. So the big data, not quite as variable, both up and down, kind of more consistent, and I think will actually support its share price moving forward in the future. So sorry for the IE test here on Everas, but this is quite convoluted, so let me do my best to explain. A few years ago, Everas bought a bunch of fairly financially poor steel mills in North America and the USA and Canada. One of those steel mills was basically being contracted to a third party called Wasnac, which ultimately was failing, at least in some regards, around a project. That's a bit they've accepted. They have also been sued for other failures on everything from sort of health and safety to poor risk control, that kind of stuff, which they are contesting. So there's a bunch of like lawsuits going around at the moment. Everas themselves are basically in the market for a general contractor to work with them in North America. Everas also pointed out that Everas North American direct employees aren't impacted by this. These are the employees and the contractors that Wasnac was basically doing, and it is plausible that many of these people will be picked back up, but ultimately it was business breakdown between Wasnac and various agencies and third parties that have caused this. I would say, and I am quite optimistic, that there will be a 2.0, basically a relaunch once Everas gets its general contractor in place, because both Everas and the government spokespeople were very positive about their relationship specifically. I think this fell very much on Wasnac. Likewise as well, I'm not quite sure how much ability Everas has to send key personnel into North America at the moment, right? Many of them are impacted by sanctions, so there is that implication as well. For me though, this is really important, this particular site especially, but the steel mills in general in America are now profitable, not by a huge amount. It's still kind of a bit of a turnaround business, I would class it as, but this particular site was being upgraded to produce the longest rail beams in the world outside of Asia, and this project is basically what's at risk. So it is quite important for the kind of next stage in rehabilitating that North American business. My concern has always been basically that Everas North American steel mills would be sort of taken away from them as part of sanctions and punishments and everything else. That hasn't happened, which is good from a purely business perspective. Again, just when they started to basically turn them around and make them profitable, etc. So yeah, a lot of drama here. I don't need to downplay the 666 employees that are impacted. Of course, that really sucks. And I hope that many of them will get picked back up once this works through. A very messy situation, basically. Next up, medical properties. So again, I remain very bullish on medical properties. I am at the higher end of analyst expectations, probably on the top end really, but I would like to see medical properties $20. A lot of the averages tend to be in the 17 to 18 kind of range for analyst estimates. The article itself here on Seeking Alpha was very positive, I would say, despite a slightly clickbaity title where it talks about, unsafe dividend question mark. But actually, it kind of says, no, it's not at risk. And further, they make the point that they're more likely to actually be increasing their dividend, which I agree with for the reasons here. The article also points out a relatively low, in fact, a very low 2022 FFO once the final quarter is wrapped up, as well as a modest payout ratio by REIT standards. And lastly, points out that the balance sheet is looking increasingly well capitalized as a combination of some hospital sales and also a repayment on a loan. So for anyone who's familiar with either my channel or MPW, you'll know that they have commercial relationships with some of their tenants, and one of those commercial relationships is about to give them 200 million in cash, which is expected to be paid without issue. So they will have a lot of cash to do something with. So this author's viewpoint was, well, the dividend is just not in any danger as far as I can see, sort of. And further argued that they'd need to see about a 20% reduction in their earnings to put the dividends at risk, which is unlikely to happen in most scenarios. So I would class the article as very positive. It's free to read, so feel free to do so. Phoenix Group, I would say here that whereas the Seeking Alpha article was solid, I called this article very crude on Motley Fool. Basically, it was like a paragraph almost as a source. But they argued for Phoenix was basically big dividend, solid, reliable company, 13 years of dividend increases, and basically don't expect a ton of growth. But to me, it was like talking purely about the life assurance and closed life funds management of the side of the business. Again, the more exciting part of Phoenix is around the wealth management / pension management. As I mentioned last week, I'm expecting Phoenix to do very well out of a regulatorily defined pension dashboard that has to be in place for, I think, August this year. And I think they bought very well and they continue to buy very well. So I think actually that, I agree with this article's viewpoint about the fact it's a solid dividend and an incredibly well hedged company. I would argue it's one of the most, certainly the earnings calls I've been on, it is the most hedged company I've ever delved into detail from a financial perspective. It hedges everything. And it kind of has very long-term horizons because of the nature of its business. So I guess that's why. But yeah, so I thought the article was valid from a dividend perspective, but kind of glossed over the more exciting growth potential aspect of this. So we'll see. One of my crystal ball predictions is for Phoenix to get to £7. So it has to start moving to get to that kind of level, I think. Next up, we've got Gamma. So I don't have any fresh news, but I did review their market day deck, which was like 40 pages. For me, I think there were two main call outs that I will share. First of all, actually, before I get to the call outs, I would say that the whole thing was very readable. It took me about 20 minutes to read through it. I'm very familiar with the business and the industry, so maybe it would take somebody who wasn't 30 minutes, but it was a very easily accessible deck. Accompanying it was like a 90-minute presentation. So that was nice to see from that perspective. The two call outs to me, the first one I did kind of know, but it was good that they were seeing it. And basically they were talking about the journey in telecoms that's happening certainly in Europe, but I think actually more globally as well, where the legacy infrastructure is gradually being retired. And the original plan was to move from analog, so copper cables, to digital, which is ISDNs, to SIP, so voice over IP, but SIP is the main protocol that's used. And then go into sort of cloud hosting and eventually to things like fully managed telecoms and IT infrastructure. Basically, there's that change from going from high margins usage to basically recurring revenue, hosting and support, etc. So Gamma's viewpoint is that journey is unchanged, but as a combination of sort of many countries in Europe bringing forward the retirement of their old copper networks, like the UK's is 2026. Everything should be off copper by then, basically. Germany has a similar one as well, and I'm sure, I know Netherlands has a similar one, and basically many countries in Europe are very similar. But as well as that, a lot of countries have also seen their people kind of move to a much more working from home and hybrid work and etc. So it's kind of necessitated the need to revisit traditional telecoms architecture, right? It doesn't make any sense anymore to have like a physical switch in your office because tons of people aren't in the office. They need like cloud telephony, quite advanced options in terms of your PBX phone systems and etc. So this is where I think Gamma are absolutely light years ahead of most of the competition and have built a lot of this stuff themselves, so very high margin stuff. So for me, it was just good to understand that they basically brought those waves forward, as they called it. The other thing to call out is, which I didn't really know, but they were basically breaking out their European businesses. So what they call Benelux, although most of it's Belgium, but what they call Benelux, Germany and Spain. And for me, it was really interesting that they were comparing those businesses, which in many ways are very similar. They call them mini Gammas, but they're very similar to exactly what Gamma looked like in 2012 in terms of the revenue to earnings, to kind of how the businesses themselves look. And what they were basically doing is saying, we need 10 years to basically grow revenue to this, grow earnings to that, and, basically get on that journey. Like the European side of Gamma is still quite modest at the moment. And, they're buying less good businesses than Gamma themselves, but that's no bad thing because Gamma's so good. So what's happened is that their recurring revenue has fallen from sort of above 90s down to sort of 88%, which is still really high by telco standards. But for me, it was really good to sort of understand the journey that the European arms are going to be going on. Gamma also has got a very deep pipeline of opportunities that they're looking at the moment. They have a couple of dozen that are sort of, at fairly late stages in being reviewed and etc. They have £80 million on their balance sheet. For a company of their size, they're basically well capitalized and continue to bring in money. And for me, it's a very long-term dividend growth company, this. So I'm looking forward to it. I thought the presentation was solid, made tons of sense, and it was very clearly presented. So again, for anyone who's interested in why I'm so bullish on Gamma, you could very easily read through that market presentation from the end of October. Next up, we got Huntington. So they basically had a bunch of what I would class as modest upgrades, kind of in the region of sort of 3 to 10% in terms of their EPS. I think the 170 EPS here is probably pushing it, but only very fractionally. Like I'm sort of expecting a very high 150 or a very low 160 for the current year. And again, this is against sort of a $14 price tag on the share price, so a relatively modest multiple there. Also, as well, a few share price upgrades, mostly in the $16 to $19 region. I think this makes a ton of sense. For me, I have a 17.20 price target. I've actually had that price target for a while, but I don't currently see an immediate need to change it. Their interest income is obviously doing very well at the moment, as you'd expect. But for me, it's more pleasing that their non-interest related income is doing so well and that they're building a very well-rounded financial institution, both in terms of consumer and business, as well as the parts of business that they're serving as well. So I may well revisit this because actually, if anything, I think I might be slightly under, but I didn't want to go to like 17.50 and just stick it in the middle. Like I'd like to actually have a deep dive into this. So when they have their next earnings, I'd like to spend some time. There is some concern with the regions that they operate in, but as they've grown, that's becoming less of a concern for me. And I think Ohio is doing just fine anyway. There's also some concern around the bad debt levels, but again, like although there was a spike in the last quarter, it's still running well below their long-term trend. So one quarter isn't particularly concerning. Obviously, I'm curious to see what that looks like in the next quarter to see if that's stabilized or what direction of travel is moving in, basically. And then I'm just going to round off the normal stuff with Huntsman. So Huntsman's been doing really well recently, and as much as I try, I can't find any reason for it. I'm assuming it's just wider industrial sector sympathy. It is possible that they've sold their textile side of their business, and that's now gone through and everything else. Again, for anyone who's followed me, that was something that they spoke about last quarter, and I've spoken about since. But again, I couldn't find any information around it. I would say as well that I see Huntsman regularly discussed in sort of scientific journals around sort of textiles and petrochemicals and resins and just about everything else. I do read the introductory paragraph and decide that it's really not for me. But it's good for me. It's good for me to realize that Huntsman is kind of being discussed in these very technologically advanced areas of chemistry, because ultimately that's what excites me about the business. So that's kind of enough for me from that perspective. But they're definitely all out there for anyone who does have a genuine interest and or knowledge in chemistry. No news on a bunch of other stuff, but really though, I just kind of wanted to talk about retailers a little bit. So retailers are my second largest slice, right? They're 20% of my portfolio. Okay, quite far behind tech, but also miles ahead of third place as well. And I've been quite bullish on retailers for a while, at least sort of 4 to 6 months. Not because I think they're like the best businesses currently you've ever seen, although I do think there's some standouts in there. But really, I just think that they're slightly overbeaten up, and I think you could make a similar argument, by the way, about house builders as well. Like, I think that the assumptions are just too bearish, like much too bearish actually, and you're sort of reading into it like a 2008 or worse crash where everyone is distressed, everyone loses their jobs, and I'm just not really seeing that in any of the Western economies that I look at, basically. You see this with the American data this week as well in terms of non-farm payrolls were really solid. Likewise, the UK's employment rate continues to hold up very well as well. And I feel like, although earnings growth hasn't kept up with inflation, a lot of people were able to get themselves into a relatively okay spot during lockdown. I know some people weren't, but some people definitely were, and savings levels increased and everything else. And I do still think that people want to spend money on sort of value propositions or entertainment experiences. I still think those things are things that people want to spend maybe slightly more stretched wallets on. But again, people aren't kind of shutting down because they're worried about losing their jobs or anything like that. I just don't see that at all. And although I've kind of been seeing this from my London bubble for many months, and I'm always very worried about, London bubble is quite different compared to much of the UK, let alone other countries. A lot of the businesses that are reporting really good results actually aren't London based at all. Like if I call out Greggs here, for example, which I would count as like a northern powerhouse company, I think they're headquartered in Newcastle, but they're definitely more dominant up north. And this is like a real success story. I mean, Greggs has tremendous branding and is just a really simple but nifty little company that works. Smashed the results, like 18% year-on-year improvement, just continues to expand, really good control of their costs, really strong ability to pass on any kind of inflationary increases to their customers, just really good. Next to, you could definitely make an argument, is one of the best companies in the UK. I think they have one of the best CEOs ever. I mean, he's a lord, but the guy is considered like mercurial, brilliant in many ways. He's actually, I think, is one of the best, most coherent business Brexit voices. So if anyone's interested, read up on Lord Wolfson, Simon Wolfson. But I think he just manages that business, and the business itself just is so good. And this is a clothing business primarily that until super recently had no online presence at all, which again, a lot of people thought was kind of mental. So, but they've been doing just fine. And I mean, not just that, they just increased their earnings for 2022. And they also bumped up their expectations for 2023. Although I would just caveat 2023 that it's still going to be down on 22. But it's basically better than analysts and also Next themselves had previously expected. So the current year got an earnings upgrade of like 4%. And I would also stress that Next, by the way, always are notorious almost for giving very conservative guidance. So it's very plausible that just as they just updated 2022 now with a sizable increase in terms of their earnings, it's very plausible that they may well do the same next year as well. So we'll see. But yeah, Next, Greggs, are very strong companies. B&M is slightly different. This is definitely the value end of consumer spending. But again, this is, to me, showing that people are potentially polarizing, right? This is maybe a market where people are either trading down or don't have any cost concerns at all, so you can go for the premium stuff, like Burberry's been doing okay recently, although maybe that's linked to sort of China reopening and things like that. So it's a bit more complicated there. But B&M also put out what I would say were very strong results as well. Ryanair likewise increased their guidance and caused a kind of read across the entire airline industry, which I felt like was slightly overdone, because I think Ryanair are the strongest of the airlines, certainly in Europe. And I think they were very smart during lockdowns to keep a majority of their staff. They basically haven't had the staffing concerns that airports and other airlines have had. So Ryanair has been able to bounce back a lot quicker. I also, by the way, love their CEO. He's always good fun to listen to. Likewise as well, for a long time I've been very bullish on Hollywood Bowl. They obviously smashed expectations as well. I still don't even think the share price really reacted as strongly as you would like. Yeah, okay, it went up 20%, but it was already down so far that, you know, I still think that share price has another 20% to go. So again, though, this is kind of value entertainment, experience, good day out with your family for cost effective, etc. And, you know, likewise with JD Sports, which is a business I don't know super well, but it's been doing very well recently as well. Again, in the kind of fashion sector where I don't pretend to be knowledgeable or interested really, so I stay away from investments in that area. But, you know, you can't, to me, you shouldn't be denying that there are these, the data is starting to show that the fears are not entirely not valid, but certainly overdone. My only concern is that basically, you know, some of these companies are real bellwethers and are considered very strong companies. Like I would say Next, Regs, Ryanair probably as well for an airline, Hollywood Bowl certainly. These are very strong companies, so my only concern would be that others won't be as strong. But to me, you know, assuming some kind of real disaster across other areas, in which case just put everything into these companies, I think you can credibly make the argument that retailers are back, and that even if they're going to have a challenging 23, you know, 22 to 24 financial years, that there is sufficient pent-up demand and ability to spend that they're going to just hold up fine. And my only real caveat beyond that is as long as the job market holds up, then I will expect people to continue to look for values, experiences, and effectively days out, right? It's not unreasonable to think that way. So that's my viewpoint. I still think as well that you could make similar arguments around restaurants, slightly more risky, but things like, you know, Texas Roadhouse, I know Joseph Carlson is bullish on as well. I get that as well. Even like the restaurant group in the UK, which is beaten up, right? If you look at Wagamama, every time I walk past a Wagamama, it's absolutely rammed. Again, a business with sort of low margins, high sales, clear brand image. There are opportunities in even the hospitality sector where I do think you have to be a little bit more careful. But even that as well, I think that there are opportunities. You could even extend that to the likes of Starbucks, maybe Pret as well. Like, I mean, Pret's a very London-based business, but certainly Starbucks, McDonald's likewise is a fair call out. And, you know, today actually on Friday, Costco likewise, like that business just never disappoints, and it's always has a very expensive share price. But another business that has a incredibly resilient business model and is basically forever in demand, right? I wish that there was a better buying opportunity, and I'm not sure you're ever going to get one. So, but even there as well, likewise, very similar. So I just really think that retailers deserve a bit more consideration than maybe the market's been giving them. I'm not going to say that all retailers are equal, but I think there are definitely sufficient reasons for optimism, and that if you're willing to sort of look into individual retailers, you can find incredibly low multiples at the moment, you know, definitely in the single digits in many cases. And, you know, and then you've got very strong scaling often businesses, or businesses already well established, but, you know, pay dividends and give you that defensiveness as well. So like Next, I'd include in that. So yeah, so I just wanted to talk through that a little bit. Again, I won't pretend like I'm a retail expert. I definitely am somewhat cautious, both because of my London bubble, as well as the fact you always have to be mindful when data appears to corroborate your opinions, right? I don't want to feel like I'm being biased here, but certainly I'm more optimistic, and this just reinforces reasons why I'm optimistic for this sector broadly, and specific companies in it in particular. So I just wanted to share my thoughts there. Any questions, comments, etc., please feel free below, and I'll do my best to respond. I'll also appreciate any feedback in terms of the new format for, you know, the images and the portfolio dashboard as well. Otherwise, thank you very much for watching, everyone. I've been the Boss Hog, and good luck for your investing. Bye for now.